Right, of course, this mining issue is certainly taking its toll on the rand. With us in studio is Mike Tonkin from Saxo Bank. Mike, good to see you as always. Just how much of a battering has the rand taken in strike season?
I think it's very interesting that you just raised the point credibility, and I think it's worth starting right there. I mean, to even suggest a wage increase of around 60%, I mean, you lose credibility immediately, and to then shift back down to 10% overnight. I mean, it really doesn't do anything for the unions. But as always, the international investor community looks at South Africa as an emerging market, a relatively small market in global terms, and every time that these sort of fears, it's very easy for international investors to pull their funds out of South Africa. We see it in the bond market, we see it in the stock market, and that naturally has an effect on the rand.
And we've seen it happening, particularly after the Marikana massacre, where we knew investor sentiment was going to be affected, and subsequent to that, we did see the withdrawal of some of it.
Yeah. And that's exactly it. And it's very liquid money that flows in and out of South Africa, particularly in the bond market. And the smallest fear is enough to ignite that sort of rush out and this big selling of the rand and pulling funds out of the country. But the mining industry, as the reporter just mentioned, now it's a very different. The landscape is very different to what it used to be. If we look back to the 1970s, I mean, we were the #1 gold producer in the world. Around 68% of the entire global production of gold came out of South Africa. Today, fast forward 2013, we produce 6%. Yeah, so it's changed significantly, and unfortunately, we've got a situation where the price of gold has been coming down, and the cost of getting the gold out the ground has just skyrocketed. We have electricity problems. We've got gold that sits further and further down. It's cost so much more to actually go and retrieve the metal, and unfortunately, it's just not the industry it used to be. So, as he very rightly pointed out, even 6.5% is a stretch. And yes, there are individuals earning a lot more in the mines, but the reality is that it is a really expensive exercise to mine this metal, and unfortunately we're just not selling as much, and the amount that we are selling, we're just not getting as much for it as we used to.
Do you foresee job losses should the employers give in to a double-digit wage increase here?
I don't think it would be immediate, but would certainly be the beginning of a very slippery slope in that direction. These mines aren't in the business of losing money, and they know very clearly where that point is, and it's got a lot to do with the gold price. We've seen it go up in the last couple of weeks, fortunately, but the reality is around $1,200, around $1,300 an ounce is kind of the break-even point for these mines. And when they get pushed on the cost side, like wages, they start rapidly approaching that point where it actually doesn't make economic sense to stay open, and that's when mines close, and that's where workers lose jobs.
Let's look at it from the workers' point of view for just a moment here. We look at the high inflation, the increase in the price of fuel, costs, transport, all the things that affect them on a daily basis. And at the same time, we do have CEOs taking home massive salaries, massive bonuses at the end of the year. How can those two be reconciled?
It's a difficult one to answer, and you don't want to. I absolutely am in favour of there being higher wages. But if you look at it from an economic perspective, as I've just described, the mines actually can't afford to do that. And I don't think paying 60% more wages overnight at the expense of potentially mines closing and workers losing their jobs is the way to go. I think South Africa has to, and we probably should have started a long time ago, is addressing these problems and the skills shortages in our country at more of a grassroots level. You're not going to tackle the poverty problem overnight by simply paying higher wages at the expense of many big businesses. So I think we need to really tackle it from grassroots level. It has got to do with education, social education, and those sorts of things, which are slightly different to what we're talking about today.
Mike, I'm just going to throw in another question on another issue here, simply because President Jacob Zuma raised the fact that in anticipation of a cutback in US stimulus, he's looking for better global coordination in preventing volatility in emerging markets. What's he actually talking about here?
Well, the Federal Reserve, which has really been responsible for flooding the market with cheap money, printing dollars, and those dollars have been finding a home in emerging market currencies where the yields have been much higher. It's one thing to call for coordinated growth, but unfortunately there's a massive economic tide that's turning with the Fed starting to what they call taper, which has reduced the amount of quantitative easing and money that they're pushing into the system. And unfortunately, that flow is now flowing out of emerging markets. And South Africa was one of the markets that benefited the most during those times of incoming funds. And unfortunately, now what we're seeing is we're really at the mercy of that tide turning and funds flowing back into the dollar, and dollar interest rates increasing, over the next 2 years.
So what sort of measures is he suggesting that should be put in place here?
Again, it's quite difficult to actually control these things. And, we've often spoken about, the Reserve Bank controlling the value of the rand. And I think it's an absolutely fruitless discussion. We don't have the resources to peg our currency or to control the value of our currency. So I think it's more talk. To be honest, there's really not much a country the size of South Africa can do to stem those flows. And unfortunately, being a resource-based economy, we are subject to the slowdown in China. China is not buying as many of our resources. They're not building as much. They're not spending as much. There's a bigger story at play here, and I think, unfortunately, a little bit too big for anyone in this country to stop.
Mike Tonkin, always good talking to you. Thanks very much for coming in.
News that moves. ENCA.com.